in all-in-one real estate. We are a real estate community, and we usually invite different speakers about different topic of real estate. Today, I'm Lucy Ferrer from the Roy Group at Keller Williams, and today we are going to be talking about equity lines and bridge loans. So I decided to invite an expert about that and invite Ryan Lee from U Mortgage so he can answer all the questions you might have about that. Me get you here. Hello, Ryan. How are you?
Hello, doing good. Hope you're having a great
Awesome.
evening.
Thank you for accepting this invitation and be able to talk about those important loans. Okay, tell me a little bit about yourself, about your background. Where are you from? Are you from here, Wichita?
So I've actually lived all over. I was born and raised here in Wichita. We lived here until about my freshman year of high school. Both my parents, my mother and my stepfather worked for AT&T, and they got transferred up to Kansas City. So ended up graduating in Kansas City and years of college up there, and then I
Hello.
yeah. Can you hear me?
Oh, yeah, you got freeze.
Oh, okay. Sorry.
No, it's fine. Okay.
Where did I leave off?
Yeah, about Kansas City, that
Yeah.
your parents, that you have to move.
Yeah, we had to go up to Kansas City. My parents got transferred for AT&T, and I finished 2 years of college up there, and then I went down to Texas and finished up my college and studied marketing. Marketing was my passion, and did a little bit of marketing down there until about 2017. And about 2017, I came back home. My grandfather had gotten ill, and I was helping my mother take care of him, and I ended up getting a job at a local mortgage brokerage as the marketing director. And the same year that I started, a 21-year-old kid started, and he ended up making more than I did on my salary on just his commission alone. So I was like, something's not right here. So needless to say, I soon got my license, and I was doing kind of a hybrid role where I was doing as the marketing director and a loan officer, and just fell in love with the hands-on experience of a loan officer. Like, seeing the families just so happy, the kids fighting over the room, and, talking about their pets that they're going to get, and just, fell in love with that. And that's what I was, telling you a little bit. Like, my passion is first-time home buyers or first-time investors, just seeing how appreciative they are, and just, setting up that, the generational wealth is just it's a blessing.
Yeah, it is. Um, Let me ask you a question. I come up with this live was because I have clients that sometimes they have their home, they don't want to sell it, but they want a bigger home and they want to buy a second home. So that's what it came up to me. Probably talk about equity lines and bridge loans. So tell me a little bit how somebody can apply for an equity line, and it's different types or it's just one?
There's many different types of equities. There's a home equity loan, and then there's a home equity line of credit. So
Okay.
a home equity loan is going to be similar to like a cash out refinance, that you'd have a standard payment that you'd make every month. I think probably what you're referring to is probably the home equity line of credit, which
Yeah.
operates more like a credit card. It even usually requires you to get, some sort of an account with a financial institution, and they can be fixed or they can be adjustable rates. Usually, if it's adjustable, there's going to be a several different rate caps for the adjustment periods. It's going to be based on a index, and it usually it's the LIBOR, or there's another one called a SOFR. So it'll be based on either one of those, and the ones that I really prefer are the fixed HELOCs. And how they kind of work is that you're going to get better terms based on a draw period and then there's a repayment period. Now, I was having a discussion with a real estate agent today about 30-year mortgages. That's insane. When we think about, we go to the closing and we see like, hey, your last payment's going to be in 2058. And
Yeah.
people are like, oh my God. And nobody in the modern times keeps their mortgage that long. The reason we have 30-year terms is because it makes your payment more manageable.
Lower, yeah.
And we're even probably going to be seeing 40-year terms eventually, you know, before it's all said and done, just because the rate at which we're getting paid is not keeping up with the appreciation of real estate. There's no investment in the world like real estate to grow your wealth. And even our wages can't keep up with it. And so, needless to say, the home equity line of credit, what you want to look for is the draw period. The shorter the draw period, the better the rate you're going to get and the better terms you're going to get on that loan. Now, the key is to only have a draw period as long as you need it. I was watching someone on the news. I can't remember what channel it was. I think it was Channel 12 or maybe Cake. And she was saying the best time to get a HELOC is when you don't need it. And I absolutely disagree with that, because you have the draw period and sometimes they're as short as 3 years. So you definitely don't want to get a HELOC when you don't need it. You want to get it when you need it, because that clock is ticking whenever you get that HELOC. And once your draw period's up, you have to get another one to use the funds.
Oh, okay. So usually what are the common terms? You say like 3 years, and if you don't use in 3 years, you have to reapply.
You got to reapply and you got to get a new one, and you incur, additional closing costs. Now, HELOC closing costs aren't nearly as high as, a standard refinance, but still you're paying thousands of dollars, for the benefit of the home equity line of credit. So you got 3 years. You can do 5 years, 7 years, 10 years. Lenders have gotten really, really, elaborate on the options. And so you can even get like a 30-year draw and a 30-year repayment period, but you're going to get worse terms than if you went for like a 10. I really like the sweet spot is the 10-year with a 30-year repayment. And the cool thing about that is you have 10 years to use it. And then after that 10-year, you get to that 11th year, you have, 20 more years to pay it back if you do choose to do so.
Oh, okay. So then, and the line, that's a line of credit, and the other is the equity loan. But in that one, it has to be done if you're going to use it right away, I guess, because you start doing payments right away.
Yeah. A home equity loan is just you're pulling out money from and it's commonly also referred to as a cash out refinance. It's just the same loan, different term, and you're going to be making a payment every month. Now, the benefit of a HELOC is many HELOCs for that draw period, they'll allow you to do what's called an interest only payment. And so it's not always advisable because you're never going to pay down that principal, but say it's Christmas, or say you have a job change and you just have some, low months. On the interest only, you're only required to make that small interest only payment, and you don't have to pay the principal unless you choose to. So there's a lot of cool options with a HELOC that's not available on a home equity line.
So, for example, if somebody wants to invest in real estate and they want to flip, they have a lot of equity in their home, and they want to use it to invest in a property, fix it. Do you think in those cases it's better just interest only? Because anyway, they are going to pay it off that's not allowed.
Yeah. What I see a lot of investors doing is they're buying properties, and maybe they have some equity built up in their primary residence, and they're going to get a HELOC on their primary. They're going to take that money out and they're going to use it for down payment and closing cost on a new property. Or if their primary is large enough, then they can just purchase a home outright, like a $50,000, $60,000 house outright with their HELOC funds. they do the renovations, they do all that, and then what they do is they do long-term financing to pay that HELOC back. So, when you purchase a home outright with cash from the HELOC, you can do everything you want, and then when the time comes, you can refinance that back out. As long as that investment property appraises, you'll be able to pull your money back out and pay back your HELOC, load that back up, and then you can do that, rinse and repeat.
Okay. So that's a good option for somebody that have a lot of equity and they want to invest in real estate.
Yeah, the last 5 years, we've seen record appreciation in homes. And so, my challenge to anyone out there listening is that if you have been in your house for over 5 years, reach out to someone like Lucy who can let you know like how much your home is worth, how much equity you may have. She can then get you in touch with, a savvy lender, that can, put you in the product that you need to maximize that. One of the things I specialize is getting those first-time investors started and learning the game. Much like first-time home buyers, I love and my passion is first-time investors. A tabula rasa that I can kind of just teach because once someone gets their seasoning on them and they get their wheels under them, you can pretty much do it yourself at that point.
Okay. And now about the bridge loans, what is kind of the difference between one or the other? In what scenario is better to use one than the other?
So a bridge loan is a unique loan product that is very different than the HELOC. What I see it more benefit is someone who is wanting to purchase a home before they sell their home. Now, it's not going to work if someone's wanting to retain that home. It only really works if your goal is to sell the home, because what this lender is doing that's offering you the bridge loan is they're actually paying off your original note, your original lender, and they're going to carry that, and it's not going to appear on your credit report. It's not going to appear on anything. But there's two bridge options. So one bridge option requires that you make a minimum payment that's going to appear on your credit report, and it's going to count against your debt to income. It's typically the standard bridge that when you go to a bank, you go to a credit union, they're going to set you up on that bridge. Now, that payment still counts against your debt to income. So when you want to purchase the new home, you not only have to overcome the new home added to your debt to income, you also still have that payment that you have to overcome in order to qualify. Now, I have some lenders, West Coast, East Coast, very savvy lenders who've developed a new bridge product. And this bridge product allows someone to have an interest-only payment that isn't due until the home sells. And so what this lender does,
wow, that's cool.
Yeah. What this lender does is they come in, and as long as you have enough equity in your home, I would say probably you want to have at least probably at least 45 to 50% loan to value. So you need to have enough equity in your house to really do some work, because what they do is they're going to pay off the remaining loan, and they're going to give you enough money to cover your closing cost, your down payment for the new home. And then that old note, that old lender, it will not appear in your credit report. It's not going to count against your debt to income. And you're going to have the funds that you need in order to make that offer on the next home without the home that you're currently living in even affecting your offer. So you can make that offer without the home counting against your debt to income. So what happens on the other end to the home that they basically paid off? You have a 12-month interest-only term with no payment due until the home sells. Well, we're in a heavily seller's market, so they typically 12 months is enough time for Lucy, if I gave you a house in 12 months, you're going to sell it. It's a no-brainer. But say it doesn't sell in 12 months, you can then for a small fee, you can extend it for 6 months, and I think it's anywhere from $1,000 to $2,000 depending on the lender, and you can extend it for an additional 6 months. So you're talking 18 months to sell your house that you have the bridge on. Once it sells, all those payments, so say it took 4 months, you'll have
Mhm.
interest-only payments for 4 months that's deducted from your equity, and then anything over and above that, you actually keep it. You can do a recast, or it'll go back to you. So it's not like the lender's just keeping all of your equity over and above. You're getting that.
Mhm.
You can do a one-time principal reduction payment, or you can do like a
Mhm.
recast payment on your new home. So
Mhm.
it's a revolutionary product. It's a great bridge product. Most banks, credit unions are not going to offer it. You're going to need to find a broker to find that kind of an offering.
Oh, okay. Okay. But it does apply to investment too, because, like, for example, the case that I have, it was that they were buying a property. They were planning to build in that land, but that property was going to be used as an investment. So they bought it like an investment. And
Mhm.
they were selling some other investment properties that they were needing that money to be able to pay for that down payment that they need.
Mhm.
So when it's those cases that they still can do a bridge loan.
They can do a bridge loan on an investment property. The loan I was referring to is only going to be available on a primary,
Yeah, that's what I was asking
a
because I
departing
didn't know.
residence to a new
Mhm.
primary. You're going to do a traditional bridge if you want to do an investment loan,
Mhm.
and you're probably going to want to have a little bit more equity. Probably, I would say probably um, at least probably 70%
Uh-huh.
equity in the home before you look at doing like pulling out a bridge for an investment. I would say probably a HELOC is going to be a much better product to do investment. Um, in
Mhm.
property acquiring for an investment. The bridge loan, really, the sweet spot on the bridge loan is going to be going from primary to primary.
Okay. Primary to primary. Okay. That's what probably got complicated because we tried to do a bridge loan and we couldn't do it.
Yeah. Bridge loan on an investment, it's going to be difficult just because the whole big deal on a bridge loan is that you're not going back to that house. And so you wouldn't want to have your primary get a bridge loan or an investment get a bridge loan because you're eventually going to have to sell that house. And so, you know, uh, there's some unique products that are bridge loans that you can decide not to sell the house and you can just pay it back. But to me, it's like, why do that when you have the home equity line of credit there that you can,
Mhm.
pretty much do the same thing without any kind of penalty that you would from a, investment bridge.
And what kind of penalty are you talking about?
So uh, the investment bridges that I know of, it basically gives you an option after the term, if it or if you choose to, you can purchase the home back, or you have to go through with a sell. Because
Mhm.
traditionally a bridge is the vacating residence, the departing residence is going to eventually sell to another occupant.
Mhm.
And that's going to be used to pay off the funds that you borrowed to get the new residence.
Okay. And those bridge loans, they are longer. How long they take to close?
A bridge loan, typically it's the same time. Now, the interesting thing about a bridge loan is it can go simultaneous with your new purchase, and so the bridge loan needs to close probably about at least a week and a half to 2 weeks before your purchase, but they can run simultaneous to each other. And so you want to start the bridge loan about a week and a half to 2 weeks before you get under contract on the purchase. And it makes sense because you want to make sure that you have a
Mm.
solid approval from the lender before you even start the purchase process on the new home.
Oh, okay. Okay. So that need to be done pre-approved before they even write a contract. Okay.
Now, there's another cool option for kind of what you're talking about. It's called a fix and flip loan. So on a fix and flip loan, what you're looking at is a 12-month term. It's going to have a balloon payment due after 12 months. So if it takes you longer than 12 months to fix that property up and then sell it, you're not going to want to do this product. And if your goal is not to flip it but to rent it, you're not going to want to do this product. But if you're just strictly a flipper out there, fix and flip, great product. Typically a pretty decent interest rate on those. You're looking at maybe about a 2% higher than what you would get on a conforming investment product. Again, those are also available interest only. And so there's even lenders out there who do an interest only, no payment for the 12 months while you're fixing it up. So it's really cool. You can also finance your repairs. So lots of cool options with the fix and flip loan too.
That's cool. And what is the down payment needed for that?
It's going to be a 20% down payment needed 20%. For that. Yeah. Yeah. Most investment products are going to be at 20%. There are some that are 15%, but the investment products are pretty, standard 20 to 15%.
Okay. Okay. Is there anything else you want to add? Do you want any experience about any of these loans that you think that it would be good to people know?
I think, a few loans that we didn't really get into that we may want to do another one is like, a DSCR loans. They're really hot right now because there's no income. It doesn't matter about your income. You can have no job.
I hear about those.
Yeah.
When you're going to buy an investment property.
And you're going to rent it out as long as the rent covers your mortgage payment.
The mortgage payment. Okay. Yeah.
But there are a few other factors that have to do with your credit, but we could talk all day about those. Down payment assistance. A lot of first-time home buyers out there are interested in that. UMortgage is one of the only brokers in Wichita who actually offers an aviation assistance for people who are in the aviation industry. It's called our Local Legends program, and you can get up to like $1,336. So if you're a first-time home buyer, you're in aviation, you get your appraisal waived, and you can get up to $737 of your closing costs covered. There's 0 down options, there's 1% options, so lots of different subjects we could cover.
Oh, I never heard about those loans. That's cool. Okay, let me see here if it's any question. And let me tell everybody how they can meet you. I think I have here your phone number. Is that your phone number?
Yeah, that's me.
Okay. Is there any other ways to reach you? Do you have any?
I do educational content. Yeah. My educational content's at Planet Cheapskate. So my YouTube channel is Planet Cheapskate. All social media, Planet Cheapskate. I do these things called loan hacks that teach you how to save money when buying homes, when buying investment properties, just unconventional things. But love to help out anybody. You just reach out, Ryan Lee on Facebook. And thanks for having me on, Lucy.
Oh, okay. Let me see if I have anything here. I don't know. They made 2 comments, but it wasn't any. They did it in Spanish. Hola, saludos. Saludos.
Saludos.
But I don't know. Nobody have any question. I guess everything was answered. It was really good. Very interesting. I learned a lot. And thank you so much for being here. And if everybody wants more information about any of the loans that he offered, there is the phone number 316-744-5819. So thank you. Bye-bye, everybody.
Thank you, Lizzie.
Thank you.